Pleasure to welcome to the stage Erika Karp, and I'm pausing for dramatic effect, Morgan Williams. And I'll give a brief intro of Erika. Erika is someone who I've known for a long time, and she's the CEO and founder of Cornerstone, and a powerhouse in this industry, a real leader, someone who I admire, someone who I feel lucky to be on the stage with, and someone who you need to listen to. Morgan is someone who I feel exactly the opposite. No, I'm joking. Morgan is someone who I don't know well, but we are huge fans of Bloomberg's, and Bloomberg's support in this area has been transformational. The way they've invested research and standards, the information they're collecting is truly remarkable, and it's a real testament to Michael Bloomberg's vision, Curtis Ravenel, Lee Ballin, and Matthew's hard work. So with that, we'll come in and sit down over here for a conversation on the future of ESG information.
Okay.
Are we going to have more questions and answers at the end of this, Erika?
It's always about the questions.
It's always about the questions.
Always about the questions.
So do investors have all the information they need to know right now to make investment decision making, or is there too much confusion, complexity out there, and we should just all wait?
No, too much confusion, too much complexity, but we can't wait. We can't wait. By the way, where did George go? So, there we go. So ice cream and sharks. It's actually really interesting. So, as a heritage kind of director of research, it's always the next question that matters. It's always the nuance that matters. So I'm not surprised at all about that stat, ice cream volumes and shark attacks. But I think it's not so much about the taste for ice cream. The reality is we're talking about temperatures of the seas changing, the seals coming into different beach areas, the sharks following the seals, right? So it's one piece of data that can lead you in all kinds of different directions. Hopefully it leads you in the direction of giving a damn about the big changes in the world. This is exactly why we have Jostein Solheim, the CEO of Ben & Jerry's, on our board of directors. So it's not time to wait. It's time to have this fierce urgency.
How do you feel about that, Morgan? Fierce urgency?
I would agree. I think that we can't wait. There's been a lot of data is kind of drip-fed through, and we've had many years of having small pieces of data disseminated in fairly, I can't quite say arbitrary, but certainly not comparable manner. And I think that, and we'll probably touch on this a little bit more, but things like SASB, TCFD, and GRI even earlier, really great ways of setting up frameworks for not just companies to disclose along, but investors to start using as part of their models when they make decisions. And without those pieces, we weren't going to get anywhere. I think that the next step is actually to increase the amount of data. And as a phrase, when I define what I do for Bloomberg, it's about democratizing that information as part of the investment process, simplifying it for both sides and doing what we can.
I don't think it's about increasing the volume of data. I think it's about better data.
It's
right?
More comparable data.
More comparable, more data that we can project. Mm-hmm. But the ability to sort through the massive amounts of noise to get to signal, that's what we're trying to get to, right?
This is always a problem with financial data, and I think that there's, again, if you look at the volume of scores that exist in the world today, there is score fatigue, and people don't know where to turn when they're trying to implement a process. I think that it's a very challenging aspect of working with, indeed, the volume of data. But I think what will aid this far more than the sheer volume, I suppose, is integration in the buy-side community. Personally, I come from a background where at Bloomberg I've worked with, as you can probably tell, I'm from London, and I work with a very long list of buy-side firms and have done for many years, and help them as much in understanding the data as integrating it into their research processes. Getting more people to understand the content better helps see the signal through the noise.
So what happens if you're integrating a piece of crap data into your analysis, or what happens there?
Well,
excuse me, that's POC. Because we're PC.
Sorry.
All data can have a signal, even bad data. The worst analyst in the world, if they get it wrong 100% of the time, I'd sell everything that they told me to
And
buy.
I managed many analysts that had that. But I really do. I think we have to be really careful with building systematic errors into our analysis. It's really dangerous. And this is, I run a firm, we're all about impact investing. That's what we do. And I have to say that, there's right now, because impact and sustainable investing is in vogue, and by the way, one day it'll just be called good investing. But when you take a bad piece of information and count on it, it really is a problem. I noticed that Paul Luff is in the room from Hess. I think I heard a story that in the data that we looked at, Hess had a really concerning number when it came to spills, right? That's a really serious thing that as an investor, I'm like, oh, I'm going to throw that out of there, or I'm going to put that rating into my, systems. And it turned out, I think, that all the spills were at the pump because consumers were pumping and dripping a little, and so that's an easy fix. That doesn't damn everything Hess is doing from the standpoint of sustainability. I'm sure we can find other things that would do that. But I'm going to give you another example. Let's say a large investment firm or a large investment bank has all the analysts making all of their forecasts, and they are using the firm's own foreign exchange assumptions. But let's say, because we know that historically foreign exchange forecasts are incredibly hard to do, so let's say they're using those numbers as opposed to kind of, public, forex curve numbers. That wrong data is making every forecast for every company in every industry and every region wrong more often than not. So I'm really a skeptic about bad data.
What's the fix for that, and what is the role of standards in that arena?
That's the standards is where it's at. You don't get innovation without standards. So that's why the work of the SASB, which is, playing off the work of the GRI, this is so critical. It takes a really long time. So over-reliance on current data is problematic, but standards is where it's at. It's a piece of infrastructure for the capital markets.
Yeah, I'd wholeheartedly agree. I think that one of the big areas where, again, Bloomberg does this for all of the types of data that we collect. We capture thousands and thousands of data points on companies and bonds and all securities around the world. For companies, if it weren't for accounting standards that we could follow, a standardized income statement, balance sheet, set of cash flows would not be possible. It wouldn't be simple for an analyst, whether they're a sell-side research firm or they're making investment decisions off the back of it, it wouldn't be possible for them to make those decisions. So I think that the work of SASB and GRI before, as you say, to define these things is crucial. There are suggestions about mandating this into SEC filings in the future, and perhaps incorporating auditing of that data, but that's perhaps some time off, I think, and will increase the burden even further on companies. But I think that this is a really good starting point, and it's going to be an evolution because the standards aren't officially 100% set, right? We're still waiting for that report, and I think I saw Jeff was over there, but he's conveniently not at his seat now. But I know that SASB, last week it was the PRI in person in San Francisco, and it was also the Global Climate Action Summit, where a whole host of different crucial and critical decisions were made. So California making a variety of different decisions about implementing net zero emissions regulations and so on. At that venue, SASB came up time and time and time again. And I think this is absolutely crucial that we start to follow it and we say, okay, we've got a starting point here. We can work through and we can start to build this into our models. And then we see where we go next. Is this data accurately captured? Is this data being consistently reported? Is this data giving me the right answer, and is it leading to market-beating returns or what have you?
What do you make of the critique of SASB and some of these other initiatives that corporate uptake isn't where it is in line with expectations? Is that a predictable surprise?
I actually think it is a predictable surprise. And the issue is we have to find a place where a company is reporting what they believe is material to their financial outcomes, but we also want them reporting related to their own kind of values and priorities. You know, and this is a governance issue. This has to have involvement of the board of directors, right? Because, you know, we also have to find a way to make it not desperately complex. So companies need to find a way to kind of balance. Do they want kind of macro meta indicators of corporate sustainability, or do they want more specific kind of granular measures? And again, to me, what they express, what they disclose, is a real reflection of the priorities. In the final analysis, it's the investor that decides, okay, what are my values? What are companies doing that are aligned with my values? So I think, you know, I think companies need to very, very carefully consider this. And I also think there needs to be care, and maybe we were going to talk about the extent to which there's been a slow progression of corporate disclosure and sustainable and impact investing. I think it really is a matter of taking the time to be thoughtful and prioritize what should be disclosed. And so I guess I don't think it's that surprising. Standards take a lot of time. I would say that I think it was about 30 years ago that we started talking about digital communications over phones and private branch exchanges. I used to sell PBXs for IBM. And to create standards for digital communication, we're talking about decades, right? So, so I don't think it is a surprise.
No, I'd agree. I think that the materiality is going to help to give you a priority list of what to provide for investors if you're not already aware of that which your investors really care about. I think that as well there has been, much in the same way from the investor perspective, there's a score fatigue, there's a burden on individual investors to decide which of the score providers to go with, which ratings provider to believe. There's also an added burden on the companies to have to answer all of the different surveys that come through. So there's a prioritization, there's already a cost that comes with being ESG friendly, so to speak, that as standards come into place, and as processes evolve, I think that will reduce some burden such that there can be more thought about what you want to provide and how frequently you want to provide it and how consistent.
But here's the cool part. The corporate sector is ahead of the investment sector in terms of using the data, which is way ahead of the public sector in terms of progress. So it's the companies, it's the capital markets that are going to drive progress. And hopefully it's just a fight to the top in terms of quality.
I like that fight to the top piece of it. So, but what, Erika, you have many years' experience both now at Cornerstone and also at UBS, running research teams, doing fundamental analysis, and Morgan, you've been looking at data for a while and helping clients through the process of integration. What keeps you up at night, and what are you most hopeful about, and why?
So I have to go hopeful. I'll go worried and hopeful. Actually, let me go with the worried. The economist John Maynard Keynes. By the way, I love capitalism, notwithstanding its flaws. But Keynes said that capitalism is the system whereby the most wickedest of men will do the most wickedest of things to the benefit of everyone. So that really worries me. You know, to make sure that doesn't happen, we do need a different kind of capitalism. We need transparency. We need a regenerative form of capitalism, kind of the circular economy thinking. And we need inclusion, right? So what I'm worried about is really a system that's run amok and the loss of trust in some basic institutions, which is certainly understandable. What I'm optimistic about is that, well, I'll find some. No, I'm just kidding. What I'm optimistic about is we do have the answers, all right? We have the technologies, we have the data, we have the capital. The question of whether or not we're going to make progress is if we have the force of will and the leadership. And on both of those counts, honestly, the jury's still out.
Yeah, I think that I'll go worry and then hope as well. I think it's always nice to end on a positive note. But I do, and I think often from a more technical perspective about how people will be integrating this into processes, because without everything being replicable and reproducible in a research process, I think it's always going to be challenging for people, for example, to incorporate the quantitative aspect of impact investing. Sometimes they don't come with a financial return, and that scares off traditional investors. How do they show to their clients that they've been able to not just deliver them financial returns, but they've been able to deliver social returns in some manner that sits nicely along the lines of the rest of their portfolios? I think that's a difficult hurdle that we've not yet been able to overcome, and I'd like to see something that works in that direction. I don't know necessarily whether the Sustainable Development Goals will help in some manner to align some of the different pieces there. I think this is still, in that respect, the jury's still out on the SDGs and how well we'll manage to integrate and map to those. But again, it's in its infancy, and I would have some hope on that front. I think where I am more hopeful, I've seen the cycles. I've been at Bloomberg for over 10 years working through these different pieces, and I've seen the initiation of our first corporate sustainability program through to where we are today with Mike sponsoring through his philanthropic enterprises all sorts of different causes within sustainability and environmental causes. I've seen ESG be a theme before, SRI in the old days, and moving through, yes, it's in vogue, then it's out of fashion. Yes, it's in vogue, then it's out of fashion. I think this time it's different. I hate to use that phrase, but there is both top-down pressure from regulation and bottom-up investor demand that's changing the way that it's working. I think with a framework like SASB, with TCFD on board as well, I think all of the pieces are there. And Erika, you're right, it's will. Will people do it? Will people get involved? And I think they don't really have a choice anymore.
I think we're getting there where they don't have a choice, but they still do, actually. And here's what's scary, and this another thing that keeps me up at night. So if impact and sustainable investing, is coming along in whatever other terms you want to use for it, we're in the midst of seeing an explosion of investable product. And I would argue that a lot of that investable product, just like a lot of corporate disclosure, is maybe not doing it right. In fact, if you miss pieces, correlation, causality, whatever you want to call it, if you put something out there as marketing, if you put a gender fund out there because they count the number of women on boards, if you put an SRI fund out there that can justify owning ExxonMobil, which, by the way, there's a lot of that, then we're at a dangerous time. So selecting the managers and the companies that are really deeply committed to doing it right, whether your values are the same or not, transparency is where it's at. But this is actually a really dangerous time, and this is why we spend so much time, to really analyze which asset managers are doing it right. I have to give a shout out to Wellington. This is an example of a firm that people wouldn't run to and say, oh, this is a sustainability firm. Some of the work that they put out there, some of the funds that they put out there, I don't care what they call them, they are impact funds. They are thinking about what's making a difference in the world going forward. And so I built my company to carry the bag for firms like that. And we have to pick our spots very carefully. So it's a dangerous time. And assuming we pick our spots carefully, then the data that George comes up with and the analysis that Bob Eccles have done that show empirically that at least you don't give up anything by analyzing ESG. If we are careful in picking our managers and our stocks, then we're going to have a lot to work with.
Yeah.
And CECP has over 200 CEOs involved in our network. You've seen over 30 CEOs willing to step up and give their long-term plans for sustainable value creation that integrates sustainability. So we've seen, and you've heard from George, that this has economic significance at early stages. What is the call to action for CEOs? How should they think through this? They're sitting there, they didn't go to business school learning this. They have different metrics that kind of they evaluate. What do CEOs need to do to really increase the velocity of the change that both of you are talking about?
I think it's about being proactive in a lot of cases with regards to the corporate culture around sustainability. I think there are a lot of really good examples. I have to say, Mike obviously is driving a lot of these things, and internally at Bloomberg, we actually, even as a private company, are very, very transparent in what we disclose. We don't have, obviously, investors in the same way as a publicly traded company would, but we are trying to lead the way and show how it can be done even as a private firm. Similarly, I think that I was very impressed when Paul Polman of Unilever, I know he's a sustainability superstar anyway, so I shouldn't be surprised, but his speech at the PRI in person last week was so impassioned. It was really spot on, and I think he is a great example of someone who is driving a change in the culture that flows all the way down the organization, that means that everyone takes within their own areas accountability and ownership of the sustainability problem.
The one thing I would add, and I agree with all that, I really do think it starts with the board of directors. And so when Emma at GSK, her comments were so consistent every time we asked her kind of the same question in a different way, which is, how you do good questioning. But there was a real high level of consistency. What we do need to hear is at the board level, aligning, the financial outcomes, the strategy, the discussions of capital allocation, culture. Those are things that I think really need to be attended to. And so when Bob Eccles talks about a culture of innovation, that goes to trust. There's one thing you have to talk about is trust. So when we look for a CEO to articulate the culture in the context of trust, in the context of innovation, Bloomberg is a perfect example. They run around trying to disrupt themselves from inside. I think that's great, and that's where we get innovation, and that's where you get change and progress.
And my 14-year-old is my disruptive technology, but in any case. So what is when we first asked people to raise their hand, we saw about half the people in the room, and we're kind of here many times and true believers, and half are probably here wondering, what are we talking about in terms of the financially significance of climate change, ESG information? So what would you say to convince them that now is the time to really accelerate the integration of this information? And what are they to do? Do they go to, what would be the first step that Cornerstone would kind of advise them to do if you feel stuck?
I just want to make sure I understand the question. So if the company feels stuck about disclosure?
I meant the investor. I'm sorry.
So the investor feels stuck about how to get to the issues of disclosure. Well, again, you go back to, by the way, in E and S and G, to us, governance by far is the first among equals. So if you're doing governance right, then you are looking at environmental and social issues. And if you're not looking at those issues, you are doing governance wrong. It's tautological. So I think you start with issues of governance. And then you start to look at, all right, I'm going to use an example literally from this morning. So let's talk about trust and consistency. Sorry to do this. Is Wells Fargo in the room? Anywhere? Okay. I'm watching TV this morning as I'm getting dressed. And there's a new Wells Fargo commercial, which is actually a really nice commercial. And the problem is I don't remember what it was for. Visually, it was nice. But in the scene where the client is, or the prospective client, is going to have, do some business or some service with the firm, a service center, wherever, and it looked really good. The person that was helping, the service agent or banker that was helping, in a wheelchair, wheeled up to the desk to do the transaction. And if it were any other firm or a different firm, I might not have even noticed that, or I might have said, okay, good, we're showing more diversity, and it should be. But because it was Wells Fargo, my first thought was, okay, are they putting that person in that ad to kind of show to me that they're progressing in terms of governance and diversity and inclusion? And so I guess because, the contract, the social contract has been damaged so badly, I was very cynical. And to that end, I don't know what the commercial was for. I was distracted. And so, I mean, I know it sounds, but that's the reality. When we're analyzing a company or an industry or an asset manager, I don't want to be distracted from what the most material issues are. And so when a company is going to disclose stuff, what is disclosed matters. Because I think in another one of George's studies, he talked about companies that disclose, frankly, irrelevant data or the wrong data. And to me, that looks like a distraction. And George's, conclusion in this particular study was that companies that disclose irrelevant information actually underperform in the stock market over the long term. That is one interesting study. So I know that's a small story, but it matters. Focus matters. Trust obviously matters. Disclosures matter. Consistency matters. Don't tell me you're totally focused on dealing with climate change when you're lobbying all over Washington to, pump more oil. Like, let's get some consistency.
You want to add on to that, or no?
I think I'd agree.
You agree?
Yeah,
Okay, very good.
I can't be that example.
Well, we can open it up for questions now. Amy?
Oh, now it's on. So if standards are the key, and they're the key to innovation, do we need 556 of them? There's 556 standards in CSR Hub that they aggregate to then create more scores from those scores. Mm-hmm. And we talk a lot about survey fatigue, and now I heard the term score fatigue. Do we need to standardize the standards? I mean, what value is there to all of us doing things separately rather than collaborating and have one?
You want to take it?
Sure. I think that thus far, everyone's been taking a crack at it, so to speak, and all of the pieces. Now we've got enough critical mass behind one major body, which is SASB, and they're thinking to push this to make it more internationally acceptable. I think that from a reporting standards perspective, this is the evolution of it, as I say. I think that once that starts to pick up a critical mass in the actual reporting from companies, so when companies start to follow and start to disclose along those lines, it will help. Now, it is more granular and more complex when you start to look at each individual industry and you understand they have to report things slightly differently. It adds some burden to the analyst side of things. But I think it should win out over time. I think those other legacy standards, for want of a better phrase, will start to fall by the wayside. I think that similarly, if we look at, as a comparison, credit ratings, there are relatively few credit rating agencies that are actually mainstream today. And I don't really want to completely use it as an example for obvious reasons, but we'll find that as time goes on, the best will survive, and they will be selected by the investment community.
And Amy, there's an issue here that adds to the complexity. First of all, I think there need to be fewer. I think it's way too complex. So that's where I sit on it. One of the things that's an issue is, are we collecting data and ratings that are associated with all stakeholders, all right, that are involved in the corporate world, or are we putting out data and ratings and standards associated with just the investors and just the companies? And there's no answer as to what that what that should be. I mean, when we founded SASB, it is about investors and the companies. And so some people would argue that that's watered down corporate sustainability. Some people would say that that's actually what we need to do if this is going to be manageable at all. Some people think that we should include some kind of basic value judgments in the data that we ask for. Some people want pure pragmatism and enhanced analytics. So there's no absolute. It's just like with materiality. One person's materiality isn't actually the same as the next person's. And if we take, Supreme Court, that materiality relates to information that's part of the mosaic of making an investment. Whose mosaic? When does it matter? When does it not? And so what we have to think about, and here's where I go with this, any single piece of ESG data is the starting point for inquiry, period. All right? Then you have to go further. But to rely on any single piece of data, and certainly, not ratings, where you might not even know what the underlying data is, you just can't rely on that. So fundamentally, the answer, of course, is it depends. It's always it depends.
When I look at the ratings field, I'm thinking of a phrase, there's good cholesterol and there's bad cholesterol. The problem is we don't know which is which, and there's way too much complexity out there. So I'm going to turn to a question now online. The burdens of ESG transparency have been borne almost exclusively by companies. How can investors better demonstrate their commitment to ESG?
Oh, I love this one. Do you want to take it?
Go.
Okay. So investors, let's talk about sustainable investing or impact investing, double bottom line, triple bottom, values-based, whatever you want to call it. The word these days, I think sustainable investing is the most inclusive, but impact investing is, what we use these days. Impact investing means intentionality. You are purposely trying to do something, all right, have some impact. Measurability, you're purposely trying to know what impact you've had. And in the center there, some people throw in additionality. But for your investment, this thing would have not happened, or but for this company. So impact investing is kind of what people are using these days. And a little continuum that people use with impact investing is that you have an input, and then you have output, and then you have outcome, and then you have impact, right? And this moves up the continuum of how you're saving the world. And so one thing that I believe that investors should do is start to really focus on the intentionality part, but also what exactly are you measuring? When we think about the SDGs, so these 17 wonderful aspirations, number 16 being about world peace. Every time I talk about it, I feel like Miss America. But if we think about great capital markets, we actually can get closer to world peace. It's real. But what are you measuring, really? And so there's a zillion measurement systems and frameworks coming out about these. So what I would tell you, and what Cornerstone thinks about, is access, right? We talk about access to capital. And by the way, everyone knows that less than 2% of all venture capital goes to women. And imagine what that number is for African American women, Hispanic women, gay women, right? So access to capital, access to education, access to energy, access to water, all right, access to infrastructure, affordable power, broadband, access. If you have a company that is doing something to enhance the world's access to the stuff that we need, you're looking forward, right? That's something that investors should care about and should demand, all right? And in terms of the actual investments that we demand, like I know places that you might want to put some money because they get that forward-looking, have an impact demand. And that's where you get both the financial and the societal return.
Want to add something to that?
I think that's a fair question. I think the following about best practices would be a fairly good topic to move on to.
What are the best practices for public companies to share ESG information, long-term strategy, through quarterly calls, analyst days, other vehicles like this?
So this very much, I think, I have to plug Bloomberg here quite clearly, but I think that engagement is extremely important. So not just reporting, but we've heard several keywords come up, consistency being one of them, transparency being another. I think consistency and transparency are absolutely key. Reporting this information in a timely, clear manner that can be expected and anticipated will help data providers such as Bloomberg gather and make it available to everyone globally, at least the 350,000 subscribers that we have on the terminal and people who consume the content that's created on the back of that. I think that providing more information in quarterly calls is great, but as we've also heard in other talks so far, it's not about short term, it's about the long term, but there need to be updates, there need to be thoughts and considerations on the topics that are material to the business and also where the long-term vision is. I think that's absolutely key.
Okay, I gotta say something.
Call to action?
Call to action is transparency and disclosure. Yeah. That's the biggest call to action. I gotta tell you this. So when Mark made his comments this morning about what Ben Franklin said about people paying too much for things, I actually got a little goosebumps, and I'll tell you why. I carry all the time in my bag an 1886 Morgan silver dollar. This was the best trade I ever did, and I was 8 years old.
I'll give you a whistle for it.
Okay. Can I tell you something? No way. But the point is, I'm selling like toys instead of lemonade in my driveway, and Randy Waltuck, if you're out there, he wanted my little blue toy pocket knife, and he kept showing me stuff, emptying out his pockets and his marbles and his whatever he had, and I was like, no. He runs down the block to his father's like vault or something, and he comes back with an 1886 Morgan silver dollar. And best trade ever. I was 8 years old. But second best trade ever was that I studied economics as an undergrad. And so when you study economics, you have a framework for everything. And finance is a wonderful tool, but it is just that, it's a tool. ESG investing, there's no such thing. ESG analysis, that's something. And you can use that to do sustainable and impact investing. Should I give him my silver dollar? No.
Well, with that, this presentation has been great, and I want to thank Morgan and I want to thank Erika for their, not just the presentation here, but for their leadership in the space.